What if I told you, you don't need thousands of dollars to start investing? You don't need a finance degree. You don't need to understand Wall Street. And you definitely don't need to predict which stock will explode next. Yet millions of people avoid investing because they think it's too complicated. They hear words like stocks, ETFs, index funds, bonds, dividends, compound growth, and suddenly, investing feels like something only experts can understand. But here's the truth. Investing can be much simpler than it looks. You just need to understand a few basic concepts. Know what you're buying, understand the risks, and create a simple strategy you can stick with. In this video, I'll explain investing from zero and show you how a complete beginner can think about building their first portfolio. Let's begin.
Let's start with the simplest question. What exactly is investing? Investing means putting your money into an asset with the expectation that it may increase in value, or generate income, or potentially do both over time. For example, when you buy a stock, you're buying a small ownership interest in a company. When you buy a bond, you're essentially lending money to an issuer in exchange for interest and repayment according to the bond's terms. When you buy an index fund, you're gaining exposure to a collection of investments designed to track a particular market index. And when you invest in real estate, you're putting money into property that may generate rental income or appreciate in value. The important word here is may. Investing doesn't guarantee profits. Prices can go up, and prices can also go down. That's why understanding risk is just as important as understanding potential returns. Now let's clear up an important confusion. Saving and investing are not the same thing. Saving is generally about keeping money available for future needs. For example, an emergency fund, a car repair, a planned purchase, or money you'll need soon. Investing is usually about putting money into assets for longer-term goals. Why? Because over long periods, some investments may grow in value or generate income. But investments can fluctuate. That's why money you may need very soon generally shouldn't be treated the same way as money you're investing for a long-term goal. Think of it this way. Saving can help protect your short-term financial stability. Investing can give long-term money an opportunity to grow. You may need both.
So what can you actually invest in? Let's break down some common categories. First, stocks. Stocks represent ownership in companies. If the company performs well, its stock price may increase. But stocks can also fall significantly. Next, bonds. Bonds are debt investments. You lend money to a government, company, or other issuer, and in return, you may receive interest and eventually repayment of principal, depending on the bond's terms. Then we have ETFs. An ETF, or exchange-traded fund, is a fund that holds a collection of investments and trades on an exchange. Some ETFs focus on broad markets, others focus on specific industries, regions, or investment strategies. And then there are index funds. An index fund is designed to track a particular market index. Instead of trying to pick individual winners, it can give investors exposure to a broad group of investments through one fund. For many beginners, broad diversification can be easier to understand than trying to select individual companies. Now, imagine you have $1,000 and you put the entire amount into one company. What happens if that company performs terribly? Your entire investment could be heavily affected. That's concentration risk. Diversification takes a different approach. Instead of depending heavily on one investment, you spread your money across multiple investments. Different companies, different sectors, different assets, potentially different regions. Diversification doesn't eliminate risk, but it can reduce the impact of one investment performing badly. That's why you may hear investors say, don't put all your eggs in one basket. The goal isn't to eliminate uncertainty, it's to avoid unnecessary concentration.
Now we get to one of the most powerful concepts in investing: time.
Imagine you invest money, and your investment earns a return. Instead of taking that return out, you leave it invested. Now, your original investment, plus the previous returns, can potentially generate future returns. That's compound growth. And this is why starting early can be powerful. You don't necessarily need a huge amount of money on day one. A smaller amount invested consistently over a long period may have more opportunity to compound than a large amount invested much later. Of course, returns aren't guaranteed, but time gives your investments more opportunity to experience the effects of compounding. And that's something beginners often underestimate.
So now you might be asking, how much money should I invest? There isn't one perfect number for everyone. It depends on your income, expenses, debt, emergency savings, goals, and risk tolerance. But here's a simple principle. Don't invest money that you may urgently need next month. Before aggressively investing, consider building an emergency fund appropriate for your situation. And if you have expensive, high-interest debt, paying that down may deserve serious priority. Once your financial foundation is stronger, you can decide how much of your available money to invest. Even starting small can help you build the habit. The goal isn't to impress anyone with how much you invest. The goal is consistency. Now, let's imagine you're ready to build your first portfolio. Where do you begin? First, define your goal. Are you investing for retirement, long-term wealth, a future purchase? Your time horizon matters. Second, understand your risk tolerance. Could you stay invested if your portfolio temporarily dropped 20%? What about 30%? If that thought makes you panic, your portfolio may be too aggressive for you. Third, choose investments you actually understand. Don't buy something simply because it's trending online. Don't invest because a celebrity mentioned it. And don't buy a stock because someone promised it'll double next month. Instead, research. Understand what you own. And think long-term. For many beginners, a diversified, low-cost investment approach can be easier to manage than constantly buying and selling individual stocks.
There are a few common mistakes worth avoiding. Number 1, trying to get rich quickly. Number 2, investing based entirely on social media hype. Number 3, putting too much money into one investment. Number 4, panic selling when markets fall. And number 5, constantly checking your portfolio every few minutes. Investing isn't supposed to feel like a casino. It's a long-term financial strategy. You don't need to predict every market move. You need a strategy and the discipline to follow it. So let's quickly recap. Investing means putting money into assets with the expectation that they may grow or generate income. Stocks represent ownership. Bonds are debt investments. ETFs and index funds can provide diversification. Diversification can help reduce concentration risk. Compound growth can make time extremely valuable. And your first portfolio doesn't need to be complicated. Start by understanding your goals. Build a strong financial foundation. Choose investments you understand. Manage your risk, and stay consistent. Remember, you don't need to become a millionaire overnight. You don't need to predict the next market winner. And you don't need to start with thousands of dollars. You simply need to start learning, make informed decisions, and give your long-term investments time to potentially grow. If you enjoyed this video, subscribe for more finance, investing, and wealth-building content. And tell us in the comments, what would you invest in if you were building your first portfolio today?